We got the first snowfall in Wisconsin here, January 6th, and I'm doing what I normally do in the winter when there's no baseball. I'm looking outside, waiting for it to be spring. This is the first snowfall of the year in Wisconsin, at least where I am in Milwaukee, where the grass is covered. So it was the first time you can't see the blades of grass above the snow, and it's January 6th. Remember, climate change, global warming aren't real. All right, I've been updating the website quite a bit lately. One of the things you'll see is a little bit different branding with the primary waves. Going to try to brand the Elliott wave aspect just a little bit for Shooter over the next year, and hope to set up a little bit of a Shooter University at some point. So he put up a lot of good charts this week. I will get these posted to margin of safety within the context of the Stocks of the Week articles, and we will have quite a bit more content coming. There's been a lot of breathiness in the first week of the year about, oh my God, we must be at a market top and the stock market's going to crash. I think that the reformed broker, Josh Brown, had it right on CNBC. And this is something that I tell you every single year, is that the first week of the year after an up year, you're going to get a little bit of selling. Why? Because people who were holding stocks last year that made money defer their taxes for a year by not selling in December, right? They push it off to January. That way they get a whole new tax year for their gains, and they trim maybe 5 or 10 or 15 or 20%, whatever it is they're doing from a wealth management standpoint. And that's why you saw the weakness in the first week. There wasn't any significant outflows. I think that you're probably going to see a pretty strong resumption of the uptrend of a January effect here for the last few weeks of the month into the Fed meeting. And then we'll see what happens at the Fed meeting, whether we get nice Jerome Powell or whether we get mean Jerome Powell. One of my friends here, Seth Golden, posted a chart on Twitter, and I just want you to understand this. Remember last week I showed you my results despite being 30-40% in cash pretty much throughout the year. You would think that I would trail the market, but no, because we sell a lot of options against that cash, a lot of cash secured puts, we actually beat the market by a little bit. So with perfect market timing, we would have matched the market if we'd been fully invested last year. We were 30 to 40% in cash and beat the market. This is what it looks like over time if you're bad at your entries into the stock market. If you just dollar cost average, which is why I talk about scaling in and scaling out, right? Little pieces at wide price points slowly. That's how we made a bunch of money on Spire Global, even though our first entry was horrific. Our second and third entries were at dirt cheap prices. And in fact, we're profitable on Spire now. Just investing when you have the money and dollar cost averaging work out to be about the same. And if you are a perfect market timer or just really good at reading technical signals like Shooter, you'll beat the market pretty handily. And that is the best way to go. What we're trying to do is something in between here and here, because that's hard. This is easy. And selling cash secured puts is very easy and allows you to have a great risk adjusted return because you have a ton of cash and you still get returns up here. So when it comes to investing, I just really want you to focus on the idea that a lot of it is systematic. If you pick a good universe of stocks and ETFs, which we've done, not even great. And I would argue that from time to time we are great. But if you pick out a good universe of stocks and a good universe of ETFs, and you work to upgrade those lists on an ongoing basis so that you are as far to the good side of the bell curve as you can, and it's really not shaped like a bell curve, but you can think of it that way. And if you sell cash secured puts against 20 to 40% of your portfolio on a regular basis, you're probably going to beat the market because a lot of your purchases are below current prices some date in the future. You've collected a lot of income, and it just works out over time. So if you invest in those secular trends that we talk about, and we're going to talk about some today, and you understand where the government policy is leading things, and you understand where we are in the cycle for the Federal Reserve and the monetary system, and your universe is carefully selected based on fundamentals and potential fundamentals. That's the thing that people have a very hard time with, is the potential fundamentals. Who's not looking great right now, but is improving rapidly and could be great in a couple of years. Because the stock market won't assign them much value a couple of years ahead of time, but 3 and 6 and 9 months ahead of time, you'll start getting those giant rallies. And then when those rallies begin, what happens after about a year? After about a year, because people look at the past year performance, they go, oh, look, that one's good. That stock went from 5 to 25. I should buy it now. I'm trying to buy it between 5 and 10 because I try to look forward 2, 3, 4, 5 years. And while that doesn't always feel good in real time, a lot of 2022, we were like, man, we just keep scaling in and getting our butts kicked. We knew that was going to be a down year, so we tried to figure out how to get in, scaled in slow, small, wide price points. I mentioned Spire Global. We bought it for the first time at a split adjusted 35, but we bought it the second time at 4 and 5, to the point where our cost basis is single digits and we're roughly profitable right now. I have some accounts that are up 20% on that one, 25%. And it's because, one, they were lucky not to be around when I made the first investments in Spire. And we pretty much bottom ticked it, investing in Spire Global in August and September of this past year. That is what wins. And it's very important that you not get breathy and out of shape and looking at today's trader narratives, because those aren't 2 and 3 and 4 years forward looking. Those are 2 and 3 and 4 months backwards looking, and really isn't going to help you very much. Traders, short-term traders in general that you find on the internet, and even the one-year analysts who are trying to say, oh, look, this one might have a 7% increase in revenue this year. Who cares, man? I can see what's happening in real time right now. Tell me what's going to happen next year and the year after. And that's how I've made all my money, is thinking like an executive, like a financier of companies, and trying to figure out, all right, if I were this CEO and this management team, what would I be doing today to get big profitability down the road? And that's hard for a today looking investor. I had an investor in December say, well, I'm going to move a whole bunch of money to cash because October was bad and he figured it out in December. I'm losing money. I was down 2.7% in the second or third quarter or something. I don't remember what he said. And I explained this to him, this chart. We'll see what he does about it. Right now, he's 80% in cash, and I can't talk him out of it. He's going to end up on that far right side. He'll make money. He'll make a couple percent, but he's not going to make much money, because if he stays out of the market too long, he's just going to miss those big up days. Goldman Sachs is saying something that I think should be very interesting to people. They're pointing to falling interest rates and a slightly weaker dollar to raise S&P 500 earnings. That was one of the things I talked about weeks ago. In addition, I threw in the AI will drive earnings up as well. So not only did we get the liquidity story right, because that's largely what this article was about, liquidity, and how a slightly weaker dollar will support the market, but all of a sudden, weeks after I said it, Goldman Sachs says it. If you've been following along a long time, and especially if you're one of the handful of people who read me on MarketWatch, you know that when Goldman Sachs and Citigroup and Bank of America and JP Morgan come in after me saying the same thing, it usually means that we're probably right. Now, if they say something and I don't echo it, that usually means they're saying something wrong, or that I just don't think is important enough to really deal with because it's too today, or I don't understand it enough to comment yet, or I'm waiting to see. So earnings in 2024 are going to be pretty good. And remember, I've showed the charts on this before. The earnings the last couple of years were basically choppy. There wasn't a big uptick in earnings for the last 2 years. We're going to see an uptick in earnings this year. The big wage increases are over with. Supply chains have normalized, bringing down costs. There's a couple of exceptions there, and we'll talk about one in a minute. But that's something where you can look forward 2 or 3 years and go, oh, these prices right now are dirt cheap. Do I want to wait for them to go up 100, 200, 300% before I invest? Or do I want to invest now while the crowd is looking at today, but not tomorrow. So what are one of those sectors? And this is something that we talk about all the time. Suddenly in Barron's, they're talking about how the power grid is changing. What company have I dropped the name of 10 times in the last 6 months? Which transmission company do I keep talking about, right? So Wisconsin Electric, and what do they own? American Transmission Company. They're majority owners, 60 or 80%, something like that. The grid is changing to be able to handle renewable energy, and it's changing pretty quick. It is moving at the speed of transformers. What do I mean by that? Transformers are backed up. It's hard to get transformers. So there is a lag time from the time the utility orders a transformer to the time they get it of between 6 and 12 months, really. It's almost a year in many cases. But the transformers they have, they're putting them in as fast as they can put them in. And over the next 5, 6, 7 years, it's really scheduled from now until about 2030, you're going to see the entire US grid upgraded and smarter. Now, it doesn't mean we're going to replace the whole grid, but we are adding a lot of capacity, and it is smart capacity that can handle alternative energy and intermittent energy. It can handle the big upticks, the big downticks, depending on the wind and the sun. And your base load is going to come from nuclear and natural gas because coal is still going away. Virtually every coal power plant in the United States will be gone in the next decade. There will be a handful left, not many. And there'll be backup plants, plants that they maintain in case of an emergency. There'll be a closed plant sitting there with a big pile of coal that a couple of guys take care of to make sure that if they have to turn it on, they can turn it on. Everything else is going to be solar, mainly solar. Wind is already petering out. There isn't going to be a lot more wind construction because the economics and the technology have been surpassed by solar. Solar is infinitely better than wind in the long run. And because, as Elon Musk has said, we have a nuclear fusion reactor in the sky that just sends us the energy for free every day. It would literally take 100 by 100 square mile area to power the entire country. That's it, 100 miles by 100 miles. Now, you're obviously not going to do that. Although if you drive through the desert, you'll find a lot of solar arrays, which has actually been environmentally positive, not just at the energy level and the emissions level, but it's good to have them there in the sand because it supports the local ecology. That's what they figured out. Probably was an accident, but that's the way it's working. So there's even more reasons to use solar. And with energy storage becoming cheap and not lithium based, because lithium means that you have a size constraint, means you need something small to store energy, and probably with instant on, instant off, like a car. The batteries that are coming and that really already exist, flow batteries and different types of chemistry that aren't toxic but are cheap, right? So non-toxic and cheap, and can hold the store of power. You can hold the power storage for very long periods of time. They already exist, and they're going into production now. Over the next 3 years, the home residential solar market is going to see a transformation. So not only have the panels gotten cheap, but the energy storage, you don't need a power wall. You can get a different type of battery. It'll be bigger. You stick it in your garage or wherever you put it, and it's non-toxic. It can't catch on fire. It's cheap. It just looks like another refrigerator. New home construction in California already requires a lot of this. We'll eventually smarten up and just apply it to the whole country, that every home either has to have a heat pump or some other source of alternative energy. Solar doesn't work everywhere very well, but it works in most places pretty well or better. A lot of solar in Michigan and the Northeast. Wisconsin seems to be talking about it at least. So that trend is a massive secular trend, and we have a game plan for it. I really want you to avoid those short-term narratives because you're not a short-term investor in most cases. Handful of you trade, and if you're doing it the way that we've taught you, which is it really is a part-time job, you should not be trading if you don't treat it like a part-time job. And I mean a 20 to 30 hour a week part-time job. You should just be a position trader and put your hour a day in with a day off here and there. So for most folks, they have 4, 5, 6 hours a week instead of 25, 30, 40 hours a week. The position trading, which are positions that you hold for quarters or years, is easy enough with 4, 5, 6 hours a week. Now, there's an argument for just hiring a guy like me. I showed the evidence last week. However, if you like having your money controlled by you, because it's your money, that's fine too. Or if you want to split it up, whatever you do, understand the dynamics. You can't be a great trader if you don't put a lot of time into it. Can't be done. I've been watching this game for 30 years now, 35 years with internships. You can't be a great trader, swing trader in particular, or day trader, if you don't put in the work. So if you don't have the time to do that, be a position trader where you make asset allocation changes gradually, slowly, small pieces. I want to pivot over to China. What was I saying 2-3 years ago? Don't invest in, what was I saying? Don't invest in what? Oh, you can say it. That's right. Nobody wanted to say it. I felt like Sam Kinison. Don't invest in commie stocks. Well, people listened, and foreign direct investment in China fell off a cliff. Meanwhile, Chinese households' personal balance sheets just keep getting better, and their stocks have crashed. These are the tech stocks. I haven't touched this chart in a really long time. Look at that. I'm going to talk to Shooter about this over the course of the next week, but I think I might be investing in some commie stocks. So we'll see. I think that this is the basing pattern we've been looking to. Could there be one more dip? There sure could be. The Chinese real estate market is still screwed up, but they have avoided contagion. This is something that's been slow moving, that they've been putting band-aids on and putting the fires out. I expect that the money that they've put into that system, which is a lot of money, I think 120 billion already, or recently, is going to coincide with a Fed easing sometime this year, and you're going to see more money from China, more money from the United States flowing into the international system. You'll see the dollar drift down. You'll see the yuan, renminbi, whatever you want to call it, drift down, and a lot of new money into the international monetary system. Europe will trail. Who cares? Japan is not going to end up raising interest rates, I don't think. I think that what they've done is probably all they're going to do. And you'll see the yen do well. You'll see the euro keep chopping along in mediocrity, perpetual forever. You'll see India get a little stronger. I don't know if their chart's going to break out or if they need a pretty good correction yet. We'll see. So we'll talk about that as well. But I think it's probably time to buy some China on the cheap, with the idea that we'll see a rebound to at least about this level here, to about 50. So roughly a double, I think, in about a year to 2 years. Then we'll see if it comes back down. And a very, very good chance that it rallies like this and then comes back down. So I think that this is probably what we see. I don't think we see this for a while, but I think that this, right, see that basing period, rally, and then comes down. And the rally lasted a couple of years, and then the same thing. So we'll take a look at the options market here. I believe this has a pretty robust options market. It has options. I just don't know if a lot of it gets traded. But I don't want to be too nitpicky here. Remember, our time frame isn't weeks and months. Our time frame is quarters and years. So if you get even if it's choppy for a while, if you get a double over 2 years or so, you can scale in now for a while and then scale out up here. You're probably going to do pretty well. I mean, to double your money in just a few years, I think is, pretty worthwhile. So that's what I wanted to talk to you about today. Not very long. I have poker tonight. I think I'm going to go in this shirt and this hat. And I am jonesing for baseball. I really am. I retired from playing when I was 45 years old. I started playing when I was like 6. So I had a 4-decade run playing baseball. And I was good enough to be on the field with almost every team I was ever on. I was on a couple of teams when I was old that, I didn't have any business on the field. But here was the thing to know about me. If I was hitting second on your team and playing shortstop, your team probably wasn't very good. But if I was a utility guy and hitting 8th or 9th, you had a championship quality team. And that played out over and over and over again. The years where I had to start and hit high in the lineup, not so good. But years where I was the utility guy and I played some outfield, played some second, played some third, and I really came to like third and hitting in 8th or 9th, because when I was fast, I was a good 9th hitter. When I was 8th, that's just where you buried me. Or when I was slow, you buried me at 8th. You think back, and you think about all the things that you did and could have done, and you're like, oh, if I had done this, I had done that. Investing's like that, right? I think about if I had worked a little harder in high school, could I have actually played in college or made it to the minor leagues? And then what could have happened after that? Could I have been a big leaguer? Well, with investing, if you keep making the same mistakes and you don't put the time in, you're not going to do very well. You're going to end up over here. And this is, in fact, where most people are, right? It used to be that people weren't indexing, they were timing the market, and it was pure fear and greed. Today, most people are dollar cost averaging in, but they still panic once in a while and they pull their money out for these little bits of time and they get it wrong because the market almost always goes up after they do it, right? They panic sell the bottoms, which is how you get your bottoms, your big blow off bottoms. And then they end up, somewhere performing somewhere between here and here. You need to avoid both of these things. You should be able to operate over here. And honestly, if you'll take the time to learn how to sell cash secured puts, you'll be over here. And I've shown it over and over and over again. I pile cash into my accounts over and over and over. And every now and then, one of those small caps goes to the moon. And that's what you do. You wait. And you can't try to predict exactly when the catalyst at a company is going to make the business better or when investors are going to start chasing it. Sometimes they front run it. They're like, oh, this is about to happen. And they start piling in. Sometimes the catalyst is months and months or quarters and quarters or even years ago. And then people just realize, oh, look, this one's been going up for 2 years. And then you get that kink in the curve and your FOMO rally. Don't try to explain it. Just understand that human psychology is filled with rationalizations and fear and greed. And if you know your companies and you understand what's really going on, you get in front of those catalysts and you just wait for the herd to show up. Because at some point they come over the hill. That's the way it works. And in your shorter term trading, yeah, in those condensed time frames, the technicals work real well. And in the very long term, here's what I can tell you. Good companies go up in price. That's just what happens. Sometimes they get ahead of themselves and they have a pullback. You buy those pullbacks. Buy the dip has been the best strategy in my entire career. Buy the dip and avoid the calamities. And there's only been 4 calamities in my 30 years in business, every 7 years, give or take. You had a crash, the dot-com crash, 2000 to 2002. 9/11 was in there, probably made it last a little longer. You had the financial crisis, 2008, 9, 10. COVID, there was kind of a stealth bear market in 2014, 15, 16 when the market chopped sideways. I talked about that for years as being the base in the market. I don't think we're going to see it. 2018 was a little bit volatile, but if you had bought, I put out a buy alert on Christmas Eve, which was the absolute bottom. We hit the bottom within hours. It was only a half day of trading. I said sell almost everything a month before anybody else did when COVID hit. I was way out in front on that. I put the first post about COVID up in January of 2020, saying this is the most important story in the world. Everybody ignored me. They had no idea what is Spano talking about now. At the end of 2021, I sent out warnings, like 7 articles. The Fed is telling you get out of the way for a while. We got a 10-month correction. I am surprised that the bottom in 2022 was in that November. Surprised we didn't go a little bit lower. It just proves how much money is out there, how much capital there is to be deployed. And now because we had one good year, we're not even back at all-time highs yet. We recovered most of the bear market. Now people are like, oh my God, it's got to go to hell again. It's not. Can it be choppy and volatile? Do we have to fix the commercial real estate problem? Sure. Does China have a real estate problem to fix? Sure. But everybody learned from the financial crisis. Get ahead of it. Don't deny it's a problem. And then go through the things that can fix it. Almost like a 12-step program. And that's why you have to treat investing like a profession and not like gambling. That's why you need to know what you're doing and understand what you're getting into. Not just say, oh, well, somebody else did it, so I'm going to do it too. Or I'm afraid, so I'm going to sell. Or look, it's going up to the moon, so I'm not going to trim. Systematic approaches work. The one that I use works. And I think that with the overlay of some extra technical analysis, which Shooter and Teresa do for us, I think we're going to still keep killing it. So I'm going to put out the global trends for January tomorrow. The stock articles are already up at both websites. So we have the punch card stocks for growth. I put out the dividend one in December. So there's that. I have Shooter doing the longer term charts. And again, these will find their way into the stocks of the week over at Margin of Safety because I want to be able to explain them. I mean, if you're at fundamental trends and you've got a dose of Shooter, I don't need to explain this to you so much. If you're at Margin of Safety, I want to be able to explain some of this stuff. The format I'm using on punch card stocks, pretty simple. I'm giving you the quick thesis. And coming soon, a new feature on the website. It's going to be Kirk's take on Microsoft or Kirk's take on Amazon, whatever you want. And it'll be a very brief 300 words with a chart or two article. It'll be like a quick sheet. So I talked to Teresa about this, and I think she likes the idea. But it'll be a quick sheet that basically says, here is where the big supply and demand zones are. You can trade within there. You can scale in there. However, this is where the institutions and the rich guys start to pile in money. So if you want to be purely a bottom fisher, which I think is a pretty good idea because you only have 20 or 30 stocks that you should be into, you can do that, and then you can sell some options, sell puts along the margins against your cash position. I think that you'll beat the market pretty handily most years, and you'll do it with less risk, and every now and then you'll hit a home run. So if that sounds good to you, stick around because I think the next year and a half could be pretty amazing for a lot of these small companies. Tom Lee over at OptionStrat, they're all in on small caps and industrial stocks. And industrial stocks is really where I think a lot of those earnings gains are going to come. The application of AI and the cessation of big wage increases, right? We had a big step up in wages the last 2-3 years. And it was one of those things that was part political, right? Because that's Biden was pushing it. But it was also just another product of COVID, overlaid with the big secular trend of boomers retiring. So a lot of this is just the playing out of history, which we don't have a lot of control over, right? Demographics, giant events, we don't control that. We just invest in it. All right, let me pause this and we'll get Shooter on for a little major markets action.